Want to begin by thanking everybody for joining us today. Hope you can all hear us okay. If not, there'll be a recording that goes on at the end of this event. Why we are doing this, Stone and Browning Property Management is trying to become more of an educational hub for our clients and uh, potential clients as well. There's a lot happening in the industry right now as it pertains to investment property, and we just want to make sure we're providing all of our clients and potential clients with, easy access to information, and some tools and some education that can kind of help better their businesses, and help us work with you better as property managers too. Um, invited Dave Rubel today from Community National Bank to come talk with us about the kind of the commercial lending environment. As property managers, we always talk about the levers we can pull to manipulate the cash flow picture of a building, and one of those biggest levers is the debt world. We worked with Dave for quite a few years now, Dave, and you've been a big asset to our business and our company, and just really happy to have you here today to kind of educate us more on the commercial lending environment, and looking forward to getting into some conversation with you.
Thank you for inviting me today. This will be a fun conversation for sure.
Absolutely. You want to begin just by telling all of us kind of, your background, where you've come from, where you've been, why you landed at Community National Bank, and what you enjoy most about your position there?
Sure. Yeah. Well, thank you for that opportunity. And I've been with Community National Bank since 2014. It's the only bank I've worked for. Proud to say we're celebrating our 175th anniversary this year. And I got into commercial lending a little bit different than a lot of lenders. I didn't start off in banking. I actually worked for Vermont Small Business Development Center. I was a business advisor for Central Vermont, Lamoille County, and I networked with a lot of different banks. I was helping my clients prepare business plans and financial projections so that they could obtain financing. So we're working not on the opposite side of the bank, but partnering with banks. And so I was invited to apply for a position at Community National. It was my favorite bank to work with. Starting off as a portfolio manager, and I had the chance to work with one of the bank's most active lenders and really cut my teeth in a support role until I had the chance to move into lending. And I started working with Mark and Ruben right around the time that I became a commercial lender, commercial loan officer, and we've had a lot of fun over the years. It's been
Yeah.
a real pleasure helping you grow your business and your portfolio. Other than that, I come from a family of entrepreneurs, so I grew up in an environment, never seeing my grandfather or my father work for someone else. They were self-employed. So I feel like even though I'm an employee, W-2 employee, I really grew up in a sort of small business environment and have a lot of respect for entrepreneurs.
Yeah, that's great. And we began working with you early on, so it's nice that you kind of came from the world of like helping businesses put their plan together and their story together before presenting them to their commercial lender that they're going to work with. And now you're kind of on the other side where it's like you're kind of anticipating your borrowers coming to you with that plan in place already, which we'll get into a little bit later on about how us as borrowers can present well to not just you as a banker, but any banker that they're choosing to work with. Um, our client base is kind of a varying client base. We have people from all walks of the investment world, whether they're continuing to grow or going through refinance events or looking to exit, whatever it might be. I think our conversation today, hopefully we touch on a little bit of something that will appeal to everybody. So looking forward to getting into it. So I guess I kind of talked about it right out of the gate. That's one of the biggest things that you've taught us over the years is to just kind of make the lending process as streamlined and easy as it can be. What can we do as borrowers for you to come prepared to prove to you as a bank that uh, we are lendable from the point of view as far as having our plan in place and telling a story of the project that we're looking to get financing for.
Sure, yeah, and I think it's important to understand too. I mean, this is not Shark Tank, like when you're dealing with a lender, it's not, you've got 2 minutes to make your pitch, and if you fail, then you don't get the money. It's not like that. We're developing a relationship, especially if it's, you know, new. If you're meeting with a loan officer for the first time, I think there's chemistry is important, like there, and that could mean a lot of things, but you want to find somebody that you can work with, both professionally and that you enjoy working with. I certainly look at it that way. I'm not the perfect fit for everyone, but I know there are a lot of folks that I can work with and enjoy working with, and vice versa. What I will say that is really important to me is that the story makes sense, like the narrative. So I think before you meet with a lender for the first time, get your story right. You may not have all the financials and the information ready, but you should have, be clear in what you're looking for. I find clarity of thought is really helpful when people are like all scattered, don't understand what they're looking for. It makes it more difficult to help them. So when I was a business advisor, it was a little bit different because part of my process then was to help people work through, the scattered part. But as a lender, that's not really my role. My role is to help you when you know what you want. So that's just like a big picture thing. I will say that when it comes to your financials, a couple things that you'll want to have sorted out before you talk with a bank. Um, if you're not using a service like Credit Karma or with your most credit card companies will offer you a chance to get your FICO score and like sort of see where you stand. So you want to make sure that your credit is in good standing. And that can mean that, did you miss a internet bill and they're chasing after you, you have a dispute or a cell phone bill or some sort of random charge off that occurred 5 years ago that you haven't resolved. So make sure that your personal credit is in order because we run your personal credit. The other thing is that it really helps to have a good tax preparer, CPA on your team, and get into the habit of filing your taxes and not being on extension. Um, there are reasons why business owners do go on extension. We get it, and we can work with you on that. But timely, current financials are really important, and being able to provide those. This time of year, we're in tax season, so you may not be able to provide your 2025 taxes, but you sure should be able to provide your 24, 23, and 22. So your last 3 years of tax returns. The other thing is something called a personal financial statement. We have a form that we use that it's an Excel or PDF, and that's a form that you can use to submit to us. That is a summary of what you own and what you owe, your assets and liabilities. We are perfectly fine with you using your own form. If you use Google Docs or what we ask is that you sign our form. You say see attached. So like tax returns, personal financial statement, personal credit, and then on to if you have a deal that you're bringing to us, multifamily, current rent rolls, you don't have tax returns for 25, a P&L from 25, a summary of your expenses for the subject property, so that we can unpack what's actually happening in the property or properties that we're looking at. You're muted, Ruben.
Thank you, Dave. So I just want to pause there 1 second as we get into the meat of it. I just want to remind everybody if they have questions, they can use the Q&A tab at the bottom at the end. We'll try to get to all of them that we can within the time limit. So feel free to just plug all those in there and we'll address them at the end. I want to come back to real quick, Dave, because you just transitioned to the project as it pertains to if you have a deal and we're bringing it to the bank. A lot like you, even in the property management world, we love when our clients come to us and say, here's the project I'm looking at, here's what's happening currently, here's the issues I'm identifying, and here's how I want to transition the project. That's a big piece that, even when we've come to you with projects that we've acquired or helped some of our clients along the way with you as well, that's a big piece that just makes everybody's jobs a lot easier and more transparent if you as an investor or a property owner can explain what you're trying to accomplish with the property and the project and what expectations are. So
Absolutely.
yeah. Is there anything that in that plan that's just nice for you to see? Like, do you like investors to come to you with their own projections of things so you can kind of see how they're going to expect things to play out for the next 12, 18 months?
Yeah, absolutely, especially if there's substantial changes. So, if you're going to be renovating the property and you're going to be making improvements to the rent after those renovations, if you're increasing rents for a one, say there's it's a 6 unit and they're all 2 bedroom apartments, or it's a mix of 1 bedrooms and 2 bedrooms, and rents are going up 25 to 30%, sort of explaining to me, well, what your plans are. We can have a discussion. It's like, okay, can the market
Yeah.
support that? How long is it going to take to uh, absorb these new units? Like, I love those conversations. And also, I've been doing this long enough and doing it in central Vermont, the Upper Valley, some in Chittenden County, out in Lamoille County. We can have some like good dialogue. I can sort of test your assumptions, ask difficult questions. Sometimes that's really important to defend your assumptions, and I'm happy to do that to get into the mix. Not because I don't believe you, but because that'll solidify your business plan.
Yeah. That's one thing we've enjoyed working with you over the years with is, you're very just open and comfortable with just asking the hard questions that need to be asked and need to be thought about. And sometimes they're easy to just kind of gloss over. So we really appreciate you being that being that person in our corner. Does the presence of a professional property management company in the picture change the bank's perspective at all?
Yeah, it almost always benefits, the deal because, we're constantly thinking about succession planning and, that worst case scenario if the bank has to take over the property. And thankfully that doesn't happen very
Right.
often, but we want to have a team in place that if the property owner isn't able to take care of the property and the spouse can't step in or partner, it really gives us confidence, especially if it's a professional company.
Yeah, got it. So as we transition, a lot of our clients, the majority of our clients are dealing with commercial loans. We have some that are in the residential world dealing with residential loans, but can you speak to the biggest differences in how the underwriting changes when it as it pertains to residential versus commercial?
Sure, yeah. So, and I'm not a residential lender, so just keep that in mind with my response. I mean, the biggest thing is if you're borrowing as an LLC, uh, which is typically what we'll see with investment properties, you're not eligible for a residential loan unless the residential lender doesn't catch it for some reason. So, an LLC is a borrower, you're getting a commercial loan. Typically what we'll see with residential loans is that, for a first time buyer buying a 1 to 4 family, is beyond that, you can't qualify for residential lending. Maybe it's owner occupied. At 4 unit, you live in one of the units. Um, a residential loan is sort of good because you can get a 30-year fixed rate often, and that can be really beneficial. And there are other reasons why, but most of the folks that I'm working with, if they're borrowing as an LLC, even if it's a 3 unit or a 4 unit, that is a commercial loan. Some things to consider with commercial loans, maximum repayment period is 25 years versus 30 years, as I, touched on. The amount that you're putting down in a typical commercial loan is going to be 20%. There are exceptions to that, which we can get into. That's another piece. And a typical commercial loan, what I've seen is that we're looking at what, if you're familiar with residential and R, so it'd be a 5-year fixed rate. That's pretty much what I'm seeing most of the time. We can do different options, a 7-year or a 10-year, a 3-year. We can really do anything, but most of the time the sweet spot is a 5-year fixed rate. So that means that every bank's different, but you have a locked in rate for 5 years. After 5 years, you will have the opportunity to lock in a new fixed rate. We generally don't do balloons, which sometimes you'll find with credit unions, not a ton of banks in this market. But that means if there is a balloon, that after 5 years, if there's a 5-year balloon, you must refinance the loan. The loan matures and you owe whatever balance there is. That's not something we do, but you may encounter that as an investor.
You do more of a rate modification at that point in time.
Correct, yes.
Yeah, got it. Okay. So just a couple things to highlight that I heard you say was, generally for the most part, no matter how the asset is owned or going to be owned, if it's over the 5 unit mark, it's qualifying for the commercial lending environment anyway and ineligible for residential. The
Correct.
risk that we tell all of our clients is even if it is residential, it has to be in your personal name usually. And that's an asset protection piece that opens you up for a little bit of liability personally if anything were to happen at the building. So uh, commercially is generally, the way a lot of our clients go, but because of the longer amortization and, lesser amount that you have to put down to close on things, sometimes people do go with the residential route at times. So um,
It's a
on
good
the
way to get
yeah.
started. I'm not opposed to it, but depending on the bank, the terms may not be as favorable for a multifamily. It's hard to say. It's worth talking with a residential lender though, especially, if it's your first purchase and it's a 1 to 4 family. Why not?
Yeah. All right. So I'm an investor. I come to you with a project. We're going the commercial loan route. I'm working with you, Dave Rubel. And what are the parameters at the bank that we have to kind of play within and follow? Like, how much can I come to you to borrow before we trigger this, having to go to credit committee, basically?
Sure. Yeah. And just to clarify, credit committee is with Community National Bank, it's our commercial lending team and our management team. That's what credit committee means. It means that the idea is that I can, as a commercial loan officer, lend a certain amount using my own authority. After a certain threshold, there are more eyes on it. The more money we lend, the more risk is the idea. And so with us, our threshold is 1.5 million combined relationship, and that's what triggers going to our credit committee. Below
Got it. So
that,
that's
there are, yeah,
sorry, that's not per
go
instance. That's aggregate total.
correct, aggregate total. Yeah,
Gotcha.
yeah. And so below that, it's a combination. So it may be just me, it may be me plus one person, and then you get more eyes on it as the size of the relationship grows.
Got it. And then is there a lending limit at the bank? So we have some really ambitious investors and they're looking to grow fast. What's the lending limit before you guys have to bring other participants in?
Yeah, we're at around 16.5 million, 17 million in that range. And really what that means, just to be clear, we can go beyond that, but we partner with other, as you mentioned, community banks. So we have other banks that we work with that allow us to continue working with our clients, who have reached that size of borrowing.
Got it. And no matter the scale, you at the bank, obviously you do your own underwriting, of course, with every project. What are the biggest underwriting metrics that you're looking for from a borrower to be able to say if it's a good project or not?
Sure, yeah, and we're talking specifically about multifamily investing, or are there any other pieces to this that
No, I
that you'd
no,
like
I'd
me
say
to
it's
consider?
multifamily commercial mixed use in that ballpark.
Okay, yeah. So we can talk about both, but first of all, and let's go back to that 6 unit purchase. So someone in the trades, which is often the case, someone in the trades comes and says, I want to buy this 6 unit property. And so imagine you've got an electrician who's buying their first multifamily property and it's 6 units. So there are two sides to this transaction. There's the property. So the property, presumably there's a purchase and sale agreement. I've got the financials. I've got rent roll. I've got tax returns. I've got a P&L if there's no tax return for 25. So I've gathered the financials. I've got a purchase and sale agreement, and the clock starts ticking. So there's a lot going on. So first of all, we're gonna have a conversation. If we haven't decided that the deal doesn't make sense and the deal does make sense and everybody's in agreement, now we got to look at things like ordering an appraisal. Okay. We're going to have to look at the timeline to underwrite. So if assuming it's a 60-day turnaround, which is pretty common, 45 to 60 days, the underwriting clock begins. We usually get that appraisal ordered after getting some appraisal quotes. We'll get 3 to 5 quotes. We'll get the appraisal ordered, start the underwriting process, and start asking questions. If there's any gaps, if after I look at the rent roll, after I look at the expenses, is this property in a flood zone? Did you consider that? So if it isn't a flood zone and maybe the owner didn't have any debt and didn't have to get flood insurance, have you considered that there may be another $2,000, $3,000 in expenses that didn't fit into your own underwriting? How about hazard insurance? Hazard insurance is now a little bit more expensive than it was a couple of years ago. Let's talk about vacancy. Let's talk about, your projections with rent increases. So we're going to have a lot of back and forth and make sure that I understand what's happening with the property. At the same time, I'm running your personal credit, taking a look at those things if you didn't clean them up.
Yeah.
Did you have an auto payment that went 60 days 3 years ago? Why? What happened? We're going to look now to the other side of the equation. So you've got this electrician who maybe has some Schedule C income. So we're going to look at, which we haven't touched on yet, something called global cash flow. What does the property look like? What does the individual cash flow look like? And we combine those and we look at, the total picture. So there's a lot of back and forth. We're going to talk about succession planning. Do you have a professional property management company? We're going to talk about, sort of risk in general. And then at the end of this, after about a month, everything looks good. I'm going to prepare something called a commitment letter for you to say, everything's great. We're going to fund this. We're going to fund 80% of this deal. I communicate with your attorney who's doing the title work, preparing a settlement statement, making sure that you have your hazard insurance, flood insurance if needed. And we close this thing. Everybody's happy. So that's a perfect scenario when everything goes smoothly. But doesn't always happen that way, but a lot of the times it does if you come to the table with a good deal that you're purchasing at the right price.
Right. And one of the metrics
did that cover the process or?
Absolutely. Yeah. That was a great,
Okay.
from beginning to end, kind of all the pieces that have to come together to make it happen.
Okay.
The one I want to drill into, because it's also important for us in the property management end of things when we
Yeah.
onboard a new client or we take on a new project, making sure that the project has the appropriate amount of cash flow to cover things that come up. And I know at the bank, one of the big things you guys are all looking at is debt service coverage ratio. Can you explain
Sure.
that a
Yeah.
little bit and how important that is and how it's calculated?
Hey, make sure everybody's drinking their cup of coffee as we we get into the metrics. Yeah. Get your dose of caffeine. Yeah. It's actually pretty straightforward, in simple terms with debt service coverage ratio. That is one of our main metrics. We want to see the cash coming in over, the numerator over the denominator of cash going out, so top bottom, that you're at $1.20 compared to $1 going out in simple terms. So, 120,000 over 100,000 in debt. We add back, so we take the NOI, the net operating income, we add back interest, we add back depreciation if we're looking at if we have good financials, if we're looking at Schedule E's and we have a depreciation interest expense, so we'll add that back. So we want to see that 1.2 minimum. Now there are exceptions to that, and that means that if you've got a property that needs to be stabilized, maybe there was high vacancy for different reasons. There was flooding, 2023 and 2024. There were mitigating circumstances. If you're going to make significant improvements to the property, if you're going to be increasing rents, we'll consider that in a pro forma. So that debt service coverage ratio is based on historicals, but it also can be influenced by your projections. That's the debt service coverage ratio that I'm talking about specific to the property. As a relationship advances, there may be scenarios where we can, if you have a large real estate portfolio, we can have consideration based on the overall portfolio. If there's a stabilization period, it's not going to take 2 months, it's going to take 12 months for a larger property. We also look at global cash flow, as I discussed before with that example of the electrician. So we'll look at the subject property debt service coverage ratio, look at the portfolio debt service coverage ratio. We'll look at the global, which includes the property and the individual income. So there's quite a bit that we analyze, especially as the exposure, the loan amounts go up. We consider all sorts of factors. You're muted again.
Thank you, Dave.
You bet.
I have a little bit of a cough, so I'm trying to mute so I'm not like just hacking on the call, but I appreciate it. So just to back that up a little bit, just to dive into the calculation of that a bit more, because again, this is also a metric that makes or breaks the ability of a property management company to do the best job as well too. If we don't have the appropriate cash flow or cushion there and things pop up, it can make things really tricky and really, really hard. So the calculation is rents collected less your vacancy, less operating costs to get that net income. If on the tax returns you're adding back in interest and depreciation, so you have that net operating income, and you divide that number by the annual debt. So to your point, if the annual debt's 100,000, if your annual debt's 100,000 and your net operating income is 120, you hit that 1.2 mark right there. So and that's just again, it's a good thing for owners to really look at. And if your lender is telling you that you're not hitting that 1.2 debt coverage ratio, that metric might vary bank to bank a little bit, but for the most part, your lender is going to tell you if this is a comfortable deal from a cash flow picture or not. And if they're telling you it's not, generally you should listen.
Yeah, and I have had conversations with folks that say, I don't want to make any money off of this. Like they said it up front, right? I just want to be break even. I want to use this as a opportunity to build my net worth over 10 to 20 years. Okay.
Yeah.
You better have other income to offset that. That's where the global cash flow, and we can have that conversation. I'm not saying that's wrong. It may not be what I would do if I were an investor, but there are situations where maybe that does make sense.
Sure. And it absolutely does, for sure. And that's, from your point of view, that's when you start bringing those other things in, the global cash flow, maybe portfolio debt service coverage ratio, that kind of stuff. Yeah, absolutely. Cool. What types of things, I'm not going to ask you about rates, but what types of things are impacting those on a day-to-day basis? I mean, obviously you have how strong the borrower is, how strong the project is, other economic factors that are playing in. It's got to be a kind of a constant moving target nowadays.
Absolutely. It's a constant moving target. Everything's changing. We've been through different economic cycles, COVID, flooding, and various things happen that change the economic environment. What I would say is from what makes a strong borrower versus a weak borrower, I think that's what you're asking, and everything along the way, that spectrum. Always start with the personal credit. That's easy. I would say that if you have excellent personal credit, that could mean 800. We'll just use that as a benchmark. 4.0 and A+. So whatever, having stellar personal credit with no blemishes really makes you a stronger borrower. Versus me looking at someone that has a 600 credit score, or 620, or had various unexplainable things, derogatories on their personal credit report, and we're going back and forth and trying to unpack that. So I would start there. Your personal financial statement, we talked about that. Your net worth. that definitely impacts the strengths of the borrower. We talked about cash flow. So the cash flow of the deal and then the global cash flow, that makes you a stronger borrower. And character, you know, I mean, it's hard to quantify that, but you know it when you see it. And I think that's something. It's one of the C's of credit. Bankers talk about that. What's your track record doing deals? You know, are you an honest, um, strong small business owner, or do you have a sketchy track record, you know, in the marketplace? What else? What are some of the other factors? Those are the big ones. Yeah, I
Yeah,
would say LTV is another one. Yeah, like loan to
yeah.
value, that's another consideration. Yeah.
How much weight are you giving when when an investor comes to you with a project? How much weight are you giving to the project alone before bringing in the borrower's personal financial picture?
Well, we always start there. I mean,
Yeah,
that's the starting point for the conversation is the deal itself. But you know, very quickly we get into the personal financials as well. I mean, they're all
very
interconnected.
tight. Yeah,
I think there are like maybe some banks that only look at the deal. They'll do,
yeah,
you know, non-recourse lending. You might hear that
right.
term. I think it's becoming less common. But we expect our borrowers, if they own 20% or greater of the entity, they're going to give us a personal guarantee. So that means that we're looking at the whole picture.
Yeah, you threw non-recourse versus recourse out there. Can you just educate us on what that is for those that don't know?
Yeah, non-recourse means that or partial recourse means that the borrower isn't providing a personal guarantee. So in the case of recourse lending, that if you own 20% or greater of the entity that is borrowing, you will personally guarantee the loan. In simple terms.
Got it. Got it. Cool. Um, we're off to a good start this year. Why should folks come to Community National Bank if they have a commercial lending need?
Well, I think it's always good to have a commercial loan officer on your team, even if the first deal is not, you know, if you're looking at 6 months down the road, a year down the road. I think having a relationship first is super important. As I talked about that chemistry, you want to find somebody that you feel comfortable sharing deals with, you know, details about deals with. And, you know, I like to think of your professional team. If you're an investor, obviously a banker, you want to have a good CPA, you want to have a good uh, commercial insurance agent, and you need an attorney. So for any type of a real estate transaction, so having that team in place before your first deal is critical versus scrambling. You know, you get a deal under contract and you don't have a lender, you don't you don't have an insurance agent, you don't have a CPA, you're really starting at a disadvantage. So I am super happy to talk to anyone that is just getting started, even if they don't have a deal in place, just so we can get to know each other. And I'm happy to share what I've shared today and other things one on one.
Yeah, I would emphasize that it's equally as important, even once you've already built the relationship, to like maintain the relationship and just be in regular conversation. Every time you and I talk, you always end the conversation with, "What else do you have coming up? What can I help you with?" And you're
Sure.
just kind of
Yeah.
teeing it up for things that are going to be coming up down the line and kind of getting the conversations going now. So trying to tease any information you can out, which is great because it just makes the process easier and faster. So, and you've been
Yeah.
like an advisor to us in that world for a long time. So
Well, and I think, you know, it doesn't have to be a formal meeting in our office. I'm
yeah,
always happy to meet with folks for lunch or coffee at your place of business if you have an office. So I think I hope it's not intimidating for folks to have a conversation with their banker. If it is, something's wrong with that relationship. We
yeah,
want to be trusted partners, not, you know, prove to me why this deal is is good. It's got to be a good relationship.
Yeah, yeah, yeah. And you obviously this was more geared towards real estate, investment property, multifamily, commercial, and mixed use assets, but you do any kind of business lending out there. So if anybody has any other businesses that they are looking for loans on or looking to build a relationship with a loan officer, Dave at Community National Bank can help you out for sure.
Yeah, any business operating company, probably half of what I do is we call it C&I, commercial and industrial. Um, so in addition to multifamilies and mixed use properties, um, wholesalers, manufacturers, realtors, professional
Yeah,
services, you name it. And it makes my job much more interesting to have such a diversity of clients. And I learned so much. It's
yeah,
like it's a great opportunity to understand what's happening in the business world that, a given day I may talk with six different types of businesses or more.
got it, got it. Cool. Well, I want to spend a little time on some questions. There's a couple of them out there, but just want to kind of read them off and just have an opportunity to address a couple of them here. This was more, I don't know if it was a question, more of just a statement from a client. I don't know if you have any extra insight to this one at all, Dave, but they were making the statement that to buy real estate in a self-directed IRA, a non-recourse loan is required. So how do you navigate that when that scenario is coming into the picture?
I've only seen this once or twice, and I really have nothing to add to it. I would say that if there's a yeah, I guess I really would have to say talk to your attorney about that. I mean,
Yeah,
we're going to require that personal guarantee. Is there another way? Is there another entity that can guarantee it? Maybe this person could add another comment.
yeah, yeah. Okay. Yeah, we've never run into that with clients before, so just hadn't,
Yeah,
and I haven't
yeah,
pulled from an IRA to purchase anything to date yet, so I don't have any insight to that one either. But we can try to gather some answers on that and follow up for sure.
yeah. No, it's a great question.
Yeah. What are you seeing just in the market right now while a couple other questions come in? Are you seeing in the market right now that real estate loan volume is up or down or kind of where it was this time last year, or what are you seeing?
Our deal flow hasn't slowed.
Yeah.
I do think that when we chatted about this before, it's getting harder to make these smaller deals cash flow. Duplexes are awfully tough. When you add in the property taxes, insurance, flood insurance if it's in a flood zone, um, operating costs are going up. Now the cost of oil or gas. I mean,
Yeah.
who knows where that's going to land? It just makes these smaller deals more difficult.
Right.
Triplexes are more difficult. So I think the larger deals, the deal flow is there. I'm not doing as many of these smaller deals anymore, the 1 to 4s, but I suspect that those are getting harder to justify. That's just my intuition.
Yeah. When we came into the business in the industry, those were you could get them to cash flow a little bit, but they are significantly harder now for sure. And when you start factoring in age of infrastructure, when things break, they break big, and that big repair eats your cash flow for a couple of years, and it's just they are getting more and more difficult to cash flow. I mean, we're finding that threshold of like 6 units and above, but again, there can't be tons of deferred maintenance that comes with that either, unless you purchase it for the right price. So it's really back to the beginning of the conversation, painting that scenario, telling the story, putting all the pieces together, and what the problem is and how we're going to address it as an investor is really crucial for when you go to work with your lender or work with your property manager. Everyone's got to know that, so that way they know how they're trying to execute things. It's really important. So cool. Well, we appreciate your time, Dave. No other questions came in, so everyone will get a follow up of the recording. But yeah, just really appreciate your time. How can people get a hold of you if they have any other questions or they want to follow up?
So the best way to, I don't know if you can send my contact information out or include that. It's rather than me read it out, but I'm
Heck yeah.
always available on my cell, and email, and I welcome the opportunity to talk with folks, a quick conversation, or like I said, meet for coffee or lunch. I'd like to learn more about you. I find everybody's story is so interesting. That's the
Yeah.
best part of my job is like the why. Why are people doing this? And I think, at least this is my theory always going into to visiting with new folks. It's like trying to build a better life for yourself and
Yeah.
take care of your family and expand your net worth and develop a legacy. And so I want to hear about that. Like, we talked about all these metrics and things, but for me, I want to understand why you're doing what you're doing and hopefully be a part of that growth and getting you from where you are today to where you want to go and build that generational wealth. So I appreciate folks turning to me to help them do that.
Absolutely. Yeah, we'll definitely make sure to give your contact information out into the follow-up email so they know how to get a hold of you. And again, really appreciate your time. Thank you so much, Dave.
Hey, you bet. Thank you. Appreciate it, Mark and
See ya.
Ruben.
Have a great day, everyone. We'll follow up with an email on this, and you should get a recap of the recording. And then keep us in mind. We're trying to do these events on a monthly basis. We're going to be having one coming up on the kind of the landscape of the Vermont tenant landlord law, and that's coming up. We're going to be doing that in June. We're making some changes at Stone and Browning Property Management as well. We might do a webinar on that in the month of May just to kind of announce to our client base what those changes are and allow an opportunity to ask some questions. And then I really want to do an underwriting webinar where we can kind of educate owners and investors on what to look for when they're underwriting potential projects. Again, we talked about today, the debt is just one of the many levers we can pull to influence that cash flow picture. There's a lot of other ones that we can pull along the way. Would love to just be an educational hub for our clients on that as well moving forward. So definitely keep up with us and we'll have some good content out here in the near future. In the meantime, have a great day and we'll catch up with everybody pretty soon. Thank you.